Well, here we go and doing the most popular video series that I do on the channel, which is the stocks that I'm buying in May. It's a little bit late because it's been an absolute crazy month of earnings, but here we go. I'm going to try to do the UK version in a few days' time. I actually put this video together a few days ago. It was on Friday I put this video together. I never got around to recording it on Friday though because I was absolutely knackered from work. So hopefully I remember what each slide is and what I was going to say about each slide. So we'll give this a go. And as always, if you want to know what I'm buying and selling in real time rather than these monthly updates, the place to be is on the Patreon, and also I do 2 exclusive videos a week on there as well, and it's only £5 a month, which isn't too bad at all considering the effort that I do try put into the Patreon. So let's get started. So the first stock is Lovesac. So I didn't buy this stock, this is me actually telling you that I sold this. Now I think I made a video on this separately, but I also like to, I know some people only come watch my videos for this series, so you might have missed that video. So I want to be always transparent and tell you what I'm buying, what I'm selling. I'm not selling something quietly out in the background and hoping that people don't notice. I always tell you what moves I'm making, buying and selling, and trying to be transparent as possible. So I did tell you that I did sell out my Lovesac, and it was quite a recent buy really, but there's been a few things that changed since I bought this company only a couple of months ago. I still really like the company, and if the economy does get a little bit stronger, I would probably buy this stock again if it stays at these sort of prices. But my feeling is that the economy isn't going to get much better at the moment with the higher interest environment. Lovesac being a higher end product that does sell furniture. When you're most likely going to be buying new furniture is when you're moving house. So I think the slowdown of the housing market and also people being a bit conscious of the money in a high interest environment or a slowdown will affect this company more than what other stocks would be affected. Few people would argue that at 14 times earnings, it's still a very good value even with that risk. And that's how I used to think as well, but we're seeing more and more of this discounting from Lovesac in a lot of high-end products at the moment. And when you look at the recent growth projections, you can see here they're only offering 3% and 2% revenue growth. Now that is forecast to rebound by the end of the year, but I don't know if that's going to happen. We don't know what environment we're going to be in by the end of the year. So you could say, oh, it's attractive if it's going to grow at 11%, but if it continues growing at 3% and 2%, then I think it's quite fairly valued at 14 times earnings. And also that's impacting the profitability. If you look at the margins, because they're having to sell the products for lower, you could have an average EPS of negative 43. The next quarter is 0.14, when the year ago average is 0.45. And same again on the average side, it's expected to be higher, but that's because it's expected in the back end of the year. What happens if it doesn't happen? So very quickly you could be in a point where in 12 months time that 14 times earnings looks good for this growth, but then if they don't achieve that growth at the back end of the year, then it doesn't look at an attractive valuation. So with me being up on this position a good amount, I thought I'm going to take my profit here. And that translates to Tesla as well. Tesla was my second stock that I actually sold during the last few weeks, and I took another nice profit on this. Basically the same sort of reasons. 50 times earnings, and if you look at an expensive product like a Tesla car, people aren't going to spend this if there's a recession, tightening spend. First things they're going to cut is the expensive things that they would go buy just for a bit of safety. And we've seen this with Tesla having to cut the prices. And same again, Tesla looks an okay valuation if they're growing 50% a year and the profit's growing 50% a year. But what happens if it doesn't? What happens if you go from a year ago EPS of $4.07 to $3.45 and then you're only growing 22% a year? That's the big thing. If these profit rates are slow and the gross margins are getting hit because they're having to cut prices, if the revenue is a lot slower, the problem is that these companies they look attractive now, but if you start going at the lower growth rates, they're no longer attractive. And that's why these two stocks that I think in particular, if we were to hit a slowdown at the back end of the year, these two would be stocks that would get hit very hard or not do very well. So I thought I'd take a bit of risk off the table and sell them for a bit of profit. So those are the top 2 stocks that I sold for a little bit of profit there. Going on to the stocks that I'm actually buying. So first of all, PayPal. So I'm trying to buy PayPal massive at the moment. At $62, I really, really like PayPal. 26 times earnings, maybe not a fair reflection on what the company's currently valued at because it did have a drop in profitability last year. But when you actually look at a lot of forward metrics at the moment, you start realizing how good a value it is. Now, I'm not going to spend too long on it because I just dropped a dedicated video. My last video was on PayPal, so I'm not going to spend on it too long because of them reasons. But I mean, metric wise, PayPal is so below historic metrics. You know, enterprise value to EBITDA, it's a 9. Normally it's in the 20s, 30s. Normalized earnings on a forward basis is 12. Normally it's around about a 30, 40. Free cash flow. Free cash flow is currently a 12. Normally it's around a 30 or 40. It's historically sitting at very, very low metrics. And you could argue, well, the reason why is because they've had slower growth. And yes, they have had slower growth, but this is still a company that is referred to as a dead company. But yet net revenues are growing at 9% and 10% on an FX neutral basis. And this comes on a time where the company has just, I mean, look at this revenue growth here, 10 billion, 13 billion, up to 15 billion, 17 billion, up to 24 billion, and where we're sitting at now, 28 billion. You know, you've gone from 2018, 5 years ago, you know, 13 billion revenue up to 28 billion. The profit went from 1.3 billion up to nearly 5 billion. And even now, with the profit dip that it's on, it's doing 2.7 billion in profit. And going forward, it should grow at decent rates and the profit should come back to where it was previously. And on free cash flow point of view, you're going to be talking about a company that's putting 5 billion, 6 billion in free cash flow as well. You combine that with the fact that this company is focused on buying back 4 billion worth of shares at the moment, especially at these sort of levels. You've got Venmo with this, which is still growing massively. You've got its unbranded platform that's growing over 30%. You've got total payment volumes in the buy now, pay later. A lot of people are saying this is dead company, and then you're looking at the growth here, you're looking at the profitability coming back, you look at the free cash flow, you look at the shares that they're buying back. This right now is a really good opportunity for me, and I'm going to say out here, I am trying to make PayPal my largest position. I don't think I'll be able to catch it up to the likes of Hims or probably DraftKings unless it stays at these sort of levels for another half a year. But I think sooner rather than later, people will look at this as a bit like how they did with Meta at $80 and went, can you believe Meta went down to $80? Or, you know, like the dip off Google, off the AI situation. I think it can't be down here for long, because I remember, you know, back in 2018, 2019, people were saying how good of a company this is. Now they're broken off from eBay and they're able to operate on their own. And this was referred to as one of the best stocks to be buying on the stock market through this period of time at $110, $120. And now you look at this sort of company here, and it's 43% down since that time frame. And you look at what the company's achieved in the last few years. It's been an unbelievable achievement on the financial growth side of it, and should continue as well. And I'm going to leave that there anyway, because I did cover it the other day. InMode, so I am buying a few more shares in InMode. So InMode is a stock that I've owned since around about June 2020. So it's a stock that I just keep averaging up on. I mean, at one time it was a stock that we were up over 400% on, and we were taking 400% returns on this company, which is absolutely crazy. I think some people sometimes forget the track record that we've got on this channel. It's unbelievable. But I just keep buying, and it's had a bit of a reality check now on the share price. I do think it might got slightly overvalued, but as well as that, I think it's just got way undervalued now because of the bear market. And even though if I just held my average since 2020, I'd be up over 90%. I keep averaging up because I still think the company's at attractive levels right now. And I'm not really a channel that just wants to go, I bought this stock and then I just sit there going, oh, look, I'm up so much on my position. If I can make money on the stock, I still make money on the stock. That's still my main priority. My main priority is not showing off a portfolio with gains. I'm actually here. My priority is to make money. And if I am averaging up on the company, I don't mind if I'm going to make more money. And I do think I'm going to do that with InMode. 60 times earnings. And if you don't know, it's a non-invasive technology for basically face, body, skin, and women's wellness. So this might be something like you want to have something changed on your body and you don't want to go under the knife and have surgery for it. InMode has technology where it's non-invasive and it will treat whatever you want treating. And I think this is obviously a massive growing industry that will continue to grow, and InMode will carry on bringing new technology out to help with that. So InMode actually brought out their Q1 earnings, and as always they do pre-announce the results. The reason why you would pre-announce results is to go, look how good our results are, or potentially go, okay, our results are going to be really bad. And InMode always do it because the results are really good. And you can see here the company expects Q1 revenue to be in the range of 105.7 to 105.9. And that was ahead of the consensus of 100 million. Absolute ridiculous beat. Non-GAAP earnings were to be 0.50 to 0.51. That was above the consensus of 0.46. And I think that was around about 23% year-over-year growth. So you're getting this company here that's growing 23%. Absolute beats on revenue, absolute beats on profit. And since this time frame when they brought these shares out, which is $36, you'd be thinking with them sort of earnings, the stock would be up from that time frame. But it's not. The stock is actually from $36, it's now $34. It went even lower at that time frame, went down to $32. So when this company keeps smashing it and growing at 23% and it's trading at 13 forward times earnings and it's actually dropping off these earnings, I'm a buyer. I am 100% a buyer of this company. And if you look at the past performance as well, the execution is insane, the revenue growth is insane, the profit's insane. A lot of that profit, because they're so good at profit, a lot of it's going to its balance sheet. You look at its balance sheet now, it's currently sitting on 574 million cash, 2.8 billion market cap company, insane cash balance. So they're not actually spending that cash on too much at the moment. The reason why is because they're actually looking for an acquisition. But I've got to say, I would like them to potentially do some buybacks going forward, but it's an insane balance sheet as well you're getting here with this one. So I am a big fan of this one. As many of you guys know, they've been following the channel for at least 3 years. The next one's Walgreens. So I've noticed a lot of negativity towards Walgreens, which I was surprised about, but yeah, I mean, at $31, this is where I always said I wanted to get Walgreens, around that $30, even if I can into the high 20s, I can't see it going much lower than that, but it is the stock market, so you never know what's going to happen. But it's a 6.19% dividend yield, which is one of the, I think it's the highest that the dividend has ever been on Walgreens. And as well as that, I'm looking at this as a share price appreciation as well as a turnaround play. Now, previously, as you can see, the share price has been killed on Walgreens. The reason why? You only have to look at the financials. Previously, financially, they have done pretty poor. As you can see here, the revenue growth has been okay, but the profit hasn't really lived up to much growth. And you can see here, they've basically stayed around this 4 billion, even dipped into the 3 billion mark as well, which isn't great. And Walgreens has been slow to adapt to competition, the likes of Amazon, for example, the costs of everything going up, labour going up, and not being able to adapt to that situation. Now, there has been a change, and that's why I think the share price will move into a better direction, and also the growth will move back into a better direction as well. So Walgreens, with its physical pharmacy locations, will carry on doing okay, but the new delivery aspects that it will be delivered in an hour or you can pick up in half an hour should help drive traffic to the stores. The new appointment of Roz Brewer seems to be a good move as well, and she seems very keen on pushing Walgreens into the clinic care as well. So there's been a big investment into Village MD, and the point is that, as you can see here, you have a Walgreens, but also you have affordable medical care on site, so you can go in there, potentially, you know, after you've been to see someone that you need to go to the pharmacy, hey, it's next door, you can walk through a door and you can go to the pharmacy as well, and these two companies can tie up very nicely. So the combination of managing costs, selling parts of the business off that they don't need, also having clinic health, and also being tied to pharmacy, can kind of move or adapt Walgreens into a better business than where it has been before. And once again, we saw that evident in their recent earnings, and in the recent earnings, we saw them starting to drive up their EPS. We started to see the revenue coming back pretty strong, and as you can see here, the EPS guidance as well was hiked up from where the consensus was of $4.50 up to $4.65, and this is even with the tough CV comps going on as well. And just to add a little bit of confidence in here, Roz Brewer, the new CEO, did in the last month pick up some shares as well, which was 340k worth of shares. So ultimately, yeah, the combination of collecting a 6% dividend yield, also the turnaround share price as well, which I think will happen, makes this an attractive turnaround play for me to pick up. And that leads me on to the last one, which is Block. So I did pick up some Block. The reason mainly was because of the short seller report. The short seller report came out on the 23rd of March, and in the following few days I did decide to pick up some shares in this after the short report came out as the drop, as you can see here. Now, as this, then it has actually gone a little bit lower than where the short report did take it, so I might pick up some more shares again. But I've been a big fan of Block for many years. Some of you guys may know, may not know. I actually was a shareholder of Block previously. It was one of the first stocks I actually started posting about on YouTube, and that was in 2017. From there, the stock did go up a good amount. I did sell out some shares for a good amount of profit. maybe I could have held them a bit longer and I would have actually had a 10 bagger on my hands there. But I think it's also the fact that we went to a bit crazy valuations and that was a bit hard to predict. And then it's had a bit of a pullback since. So I don't know if many of you guys actually were. I'll be impressed if there's actually anyone from that time frame that's still watching, that was watching me when I was posting about blocking the first time. But I've been a big fan of block for many years and I'm happy to get back in at the moment. The short report for me wasn't really valid. A lot of it was based around Venmo and the claims were very exaggerated in my opinion. Block's recent earnings I was actually really impressed by. The EPS was a good beat. Revenue growth is back into a good direction as well and growing at very good rates. And like I said, they've got many parts of the business. I think they actually said now they've gone from 11 to 14 parts of the business that actually contribute over 100 million as well, which is very good. So they've got the transaction-based revenue, which is Cash App. Cash App is, I think I said Venmo earlier for block instead of Cash App actually, I've just realised. But yeah, Cash App is obviously a very fast growing peer-to-peer platform where you can send money. That's obviously one of the big drivers of Block or Square. The part that I actually invest in is the subscription service-based revenue. This is a platform that businesses are using massive, and that is the fastest growing part as well. And I'll also tell you in a second why it's my favourite part. Hardware revenue, which is the first reason why I actually bought Square in 2017. And then Bitcoin revenue, which basically the company doesn't make much money on, but they offers it as a service. So I'm not really too bothered about Bitcoin revenue. Hardware revenue isn't really that important because it doesn't generate much profit. Most of the profit of the company comes from transaction-based revenue costs, which is Cash App, and the other thing is subscriptions and service-based costs that it has with businesses. Now, this is the part that's growing as rapidly, or the big rapid growing part of the company. And actually, when you look here, the cost of revenue is the lowest. The cost of revenue on this is 264 million, and they actually bring in 1.366 billion. So you can see here, they make over $1 billion in gross profit off this part of the business, which is crazy good. So that's fantastic. As well as that, they're actually starting to bring the losses down, and it would be very good if they can bring some of those costs down as well. You know, you have to look at the products and development, and the G&A is quite high. So if they can bring those costs down, that would be very good as well going forward. But they're going to have a major profit driver in this part of the business because of the subscription service-based revenue, and that's the majority reason why I do actually buy this stock. And those are the stocks that I've been buying in the month of May, or in the last few weeks. So I hope you enjoyed the video, and like I said, I'll try do my UK version in a few days time. So thanks for watching, and I'll catch you all in a bit.